These are in listen-only mode.
Good morning. We'll be starting the webinar in a few minutes. A few more people are signing up, so we should be starting very shortly. Thank you. No, here. Just press stop recording. Good morning. I'm Ashok Gildial, member of the Realtor Lender Committee, and thank you so much for taking the time to attend this webinar. And I'd also like to introduce to you Ryan Kiefer, who is joining us and will be talking a little bit about the real live implications of the interest rate volatility and things like that. And so just to get going, we have seen so much volatility in the interest rate market, and what we are going to do here is talk a little bit about what caused it, how it affected us in terms of the interest rate calculations and the mortgage rates, and then we will also discuss what this really means to your buyers and to our clients. We're having small technical problems here, and we're about to fix it. By the way, this is the first time we're doing it from. There we go. Okay. The first part of it that I want to mention to you is that how do you ask questions? You can do it on the system, but in the past I've found that sometimes it's not that easy. So in this case, if you want to text your questions, you can text them either to Ashok at 513-600-4961 or to Ryan at 513-314-2248.
Or they could probably raise their hand and we'll unmute them.
No, we only take written. Okay. So you would have to write your questions. So when we started deciding who would be talking what, I had to do the heavy work, and I decided that I would take the responsibility of going over some numbers and drawing charts and pointing, and the easy job of interpreting all this is going to fall on Ryan's shoulders. So what happened? Let's go back to the point on the most important date for us was September 14th, 2012, when the Federal Reserve started QE3. And the bottom line on the QE3 was that they would buy up to $85 billion of mortgage-backed securities per month to bolster the U.S. economy and specifically the housing industry. So starting September 14th, this program started. And what I want to show you next is in real terms how it affected the interest rate market. So the next chart that you're looking at, oh, I'm sorry. The other part of it was that Mr. Bernanke said that they would keep on buying at a rate of $85 billion of mortgage-backed securities per month forever till the unemployment got to 6.5%, the GDP growth around 2.5%, and inflation above 2.5%. So what effect did this have on the 10-year yield? By the way, we use the 10-year yield as a basis for talking about interest rates because that is the most liquid of all the markets. Ryan, do you want to talk about how the interest rates, whether it's the 10-year yield or the Fannie Mae, which one is used more often?
Well, sure. Our mortgage rates are actually derived from what's called mortgage-backed securities. That's where the loans are all pulled together and sold off on Wall Street. But those do correlate typically very closely to the 10-year Treasury, which is what we're looking at here. There's a correlation there about 95% of the time where they will move in lockstep together. And information on actual mortgage-backed securities is a little bit hard to come by if you're researching them online, whereas the 10-year Treasury is easily accessible. You can go to Yahoo Finance or a number of different websites and be able to pull up what those rates are. And for our purposes, when Treasury prices move up, that is good for rates. That means yields move down. And then, inversely, when prices move down, rates move up, which is what we've seen here recently. Prices have dropped in the bond market, which is pushing yields and rates higher, which is what we're seeing here on this chart.
Now, in this chart specifically tracks the 10-year yield. Mm-hmm. And so what you see from the chart, starting date for this chart is September 1st, I'm sorry, and then it goes on to the 2nd of May. So, and what you see is a range from 1.5% to 2.086, and then back to about 1.62 towards May. What happened on May 2nd was a very, very dramatic shift in the attitude towards the Treasury yields and the Treasury investments. So on May 2nd, Chairman Bernanke made a statement that at some point, and this is in the media, it was being hyped as being the tapering and all that, and he said that at some point when the data supported it, the QE3 program will be phased out. Of course, we're paraphrasing his comments, and it was almost like a bomb went off. And you will see that on the next chart of what it did to the yields. So when you look at this chart, from May 2nd till yesterday, the yields moved from a low of 1.62% to 2.72%, a 110 basis point increase in the 10-year Treasury yield. Now, okay, so at one level, we're thinking about how does this affect us? And Ryan, could you talk a little bit about when we are pricing mortgages and quoting rates, how something like that completely throws everything off?
Yeah, well, it throws everything off because, remember also specifically the Fed was purchasing $85 billion a month worth of mortgage-backed securities. So even though those move in lockstep with the Treasuries, the mortgage bonds actually performed a little bit worse. We've seen yields there run up about 175 basis points. So in other words, that's 1.75% in interest rate. We've seen interest rates go from a low of 3.25 on a 30-year fix up to, pushing somewhere around 5% right now in certain cases. So it's actually the biggest and quickest rate increase since 1962. So it's created all kinds of havoc when trying to price loans because on a daily basis, it's a moving target, in trying to quote someone an interest rate these days. Thankfully, it's settled down a little bit here the last couple of weeks.
So one of the things that we noticed is that when the rate started going up, and I was trying to call a client and say, okay, you can get 4.75%, but at that point, because the yields had moved up so much higher, at that point, they were not going to be able to do it at par. They were going to have to come up with some money. Can you talk about why that happens?
Well, what happens there is there are, coupons that are out there and available that are being sold, and that's where all the loans are packaged. In other words, if there's a 4% coupon being sold right now with all the mortgages placed in it would have note rates between 4.25 and 4.75, the difference of which is retained by the servicer for servicing the loan. Well, when rates start to move up as quickly as they did, there's not a coupon available for those loans. Rates shot up to 5%. There wasn't a 5% coupon that was open and liquid and available on Wall Street. So it became almost impossible to price those loans out at a par rate, especially if we were looking at investment properties or at people with less than perfect credit. We had to charge points up front to even be able to do that loan for a brief amount of time. Now, again, thankfully, those higher rate coupons have now opened up. Rates have settled back down a little bit again, and we're back to being able to price loans at par. But there was a couple days there a few weeks back where it was, it was pretty hairy. It was tough to quote anything.
So if I was to try and understand it from my perspective, what happens is that investors out there buy certain coupons. Okay, and those coupons are determined by where the interest rate on the 10-year Treasury is, pretty much. So if the 10-year Treasury has been in the, like it was, in September through, it was in a range between 1.55% to 2.62%, well, it was okay for us to have a 4% yield, and if someone wanted 4.25%, we could give them some money, right?
Right.
But now when it moved up by 1.75% on the mortgage-backed securities, there was no coupon for someone to buy out there because it's everyone who's involved in this business finally wants to sell this mortgage off to someone else. So there is no appetite or there is no instrument by which they can buy it.
Correct.
Is that pretty much what?
Yeah, that's accurate. It's the Fannie and Freddie bonds on, the conventional side of things, and then Ginnie Mae bonds on the government side of the house, your VA, your FHA, USDA loans. And so those higher rate coupons just weren't available. There wasn't any liquidity there in the market, for a couple of days. They had to open those up.
And I guess another thing is that on a daily basis, the Treasury markets and the interest rate markets move trillions of dollars on a daily volume, don't they?
Oh, yeah. I mean, you have the Fed buying $85 billion a month, so yeah, you're billions a day.
$85 billion a month is not really going to make a difference when everyone is heading out of the door because they're panicking, and this was mainly a panic move.
Right.
So it seemed like some good sense is coming back in the market. Okay, so we had talked about how this the Fed was going to keep on doing the QE3 till they reach some targets. So are we anywhere near those targets? No. Unemployment rate is 7.6%. The gross domestic product is only growing at 1.8% annualized, and inflation is estimated around 1.5%. So I think what you're beginning to see now is some calm coming back in the market. Now, another way of looking at it is if you go back 25 years on the interest rate charts, this is where I think our job as realtors and loan officers really comes in, where we tell the clients, look, on a 25-year basis, we're still very, very low. You've got some thoughts on that?
Well, yeah, I mean, certainly historically speaking, rates are fantastic. I mean, they're not as low as they were. We're not at 3.25% anymore, but anything under 6 or 7% is certainly less than historical average, and it's certainly less than double-digit interest rates that a lot of us remember from the 1980s, or even as recently as the year 2000, fixed rates were at 8.5%. So we're about half of that right now. So it's all relative, and home affordability, housing affordability index, which we'll get into in a little bit, is great as well. So you can't complain. It's just a little bit of sticker shock for folks, when they think that 3.25% is still available and out there in the market. But another point here with a lot of this is that more often than not with the markets, it's the fear of the event is sometimes worse than the event itself. So this recent sell-off that we've had in mortgage bonds is more of the fear of the Fed exiting the market. The Fed hasn't exited yet. They haven't tapered. They haven't done a thing. It's just the fear of that happening. So ironically, what you might see once they do start to taper will be for interest rates to actually improve a little bit, because that will probably hurt the stock market, which again, I'll get ahead of myself. We'll talk about that here in a little bit.
So, but it is probably fair to say that we won't see 3.25% again.
No, I think those days are over. And barring anything catastrophic, as far as economic news, a major meltdown in Europe or China or that kind of thing, the 3% range, at least on a 30-year fixed, is probably gone.
Yeah, and the flight to quality thing can only take us that far. Yep. And I think if you remember, when the rates were 3.25%, we pretty much on a daily basis said that this is unreal. There's no way that it can stay at this time.
No one ever expected it to go that low. I mean, when we first hit 3.875, everyone couldn't believe it.
So 3.25 was definitely. Now I got to tell you something. Just sharing something between Ryan and I probably spend an inordinate amount of time looking at charts and things like that. And a lot of times I can almost hear my dad saying to me, Ryan, if you were to spend the same amount of time and focus that you do on these charts and do it on your job, you probably would be a much more successful loan officer. So, I think one of the things that happens with us is we spend a lot of time looking at these charts. And Ryan, of course, if you don't know already, is just very knowledgeable about this. So let's talk about the long-term effect. What we are being told, and these are people that we really respect in our company and research, that the 30-year fixed rate will probably settle, in quotes, between 5.5% to 6% by 2015. We are also told that we have to keep in mind the fundamentals are still intact. High unemployment, slow GDP growth, low inflation worldwide, and then all the international things that affect the flight to quality type of thing, the political unrest. Now, Ryan has some charts that he wants to go over.
Yeah, it's interesting. We were talking about before with stocks and bonds and the correlation. Historically, it was a little easier to, I guess, forecast, what was happening or what would happen on a daily basis with interest rates. This is a chart going back to 2008. The green line is the Dow Jones Industrial Average, and then the other, the red line and that going around with it are bond yields, so interest rates, if you will. And the old adage was always that if stocks were up, rates were up. All ships rise with the tide sort of thing. If the economy was doing well, the stock market was up, that usually meant interest rates weren't super low. And inversely, if rates came down, it's usually because the Fed was intervening and the stock market was also down as a result. But then if you look what started to happen back in, I guess, early 2011, once the Fed started coming out with all this cheap money in QE Unlimited, is that we see a little bit of a disparity. We've entered into bizarro world here, and that stocks are running way up, stock market has recovered greatly, and yet interest rates are down. So you have this big gap. So if you look all the way over on the right side of the page, you'll see that gap starting to close a little bit here with the stock market, maybe in a mild correction here recently, and then interest rates certainly on the rise recently. So long story short, I think these two lines will come back together eventually. The question is, which camp are you in? Do you think that the economy is really doing great and can stand on its own right now when the Fed exits and interest rates are going to shoot up to 7 or 8%? Or are you in the camp that says the economy is not really doing so well on its own, stock market probably has to correct by 10 or 20%, and that bonds would then be the beneficiary of that because people will take that money from the stock market, put it in the bonds, and thus keep interest rates probably somewhat low for the foreseeable future here until the economy can stand on its own. I tend to be in the latter camp myself, but I don't know. There's varying opinions out there, but most are thinking that rates will settle back down to probably 4 or 4.25 later this year. Maybe we'll see a mild correction in the stock market, and then as the economy continues to recover, we'll see rates up in the 5.5–6% range, maybe somewhere in 2015, as you had mentioned earlier.
Now, Ryan, just to go over it, what is the top line and what's
the top green line is the stock market. That's the Dow Jones Industrial Average, and then the bottom line there, where it separates and goes down, are the Treasury yields. So, the 10-year Treasury yielding 2.65% right now.
Okay. Now, another thing I think that must be kept in mind is that these days, because everyone follows the same data, internet and all that, the price movement that could take 3 years to develop in the old days now can be done in about 3–4 weeks.
Yeah.
So the volatility is always an issue.
Mm-hmm. This one here I wanted to talk about. This is the National Association of Realtors Home Affordability Index. I'm sure most folks on the call are familiar with this. If you take a look here, homes are still affordable. I mean, rates are up, but you look at the affordability index, it's at all-time highs in terms of what people can qualify for and how much income it takes. Next slide here, we'll go out a little more historically. This is going back to the 1990s. If you look there, most of the 90s, the home affordability index, stayed right around in the 60s, which is pretty healthy, and that's the HOI percent number over there. And then next to that, you see national median home prices and then interest rates. Fairly steady numbers for the entire decade of the 90s. And then what happens, then we get into 2005, 2006, and we can clearly see here why there was a bubble and why it burst. You look at the home affordability index in 2006, it dropped all the way down to a low of 40.4 and Q3 of 2006. Median home prices in this country up around $250,000 and rates in the mid-sixes. That just simply was not sustainable. Not a good time to be buying a home, certainly, which I personally was guilty of. I bought in 2006, but hey, that's another story for another day. So, but then you look at the numbers and where they are now, and we're back at all-time highs. I mean, we're into the 70s. If you take a look there, in 2009, 2010, home prices have come down along with interest rates. So it's certainly, even with the recent blip in rates, it's a great time to buy.
So the higher the number, the better it is?
The higher the number on that HOI, yeah, that's the Home Affordability Index, okay, which, just simply equates into, median home prices, factor in interest rates and median household income. Another way to look at it is, back in the 80s when rates were higher, double-digit interest rates, at that point in time, a house payment ate up about 35% of someone's monthly income. Today, it's about half of that. It's only about 17%. So, and in this slide kind of puts it in some perspective, of course. Back in 1989, you were looking at median home prices around $94,000. Today, even with home prices dropping back, in the mid-2000s, home prices are almost double since then. You're about $166,000 on a median home price, and you see there the monthly payment is almost identical. So even home prices, even though they've doubled, payments are about the same. Income has doubled since then, so that's where you get that home affordability that is fantastic right now.
Yeah, and this really does still talk about what a great opportunity it is for buyers right now.
Right.
And so what? From a loan officer perspective, I would have to say that we are still telling people that they are making a mistake by trying to time their decision based on what they think the interest rate is going to do. They should buy as soon as they are ready and as soon as they want. And maybe you can talk a little bit about what happens if they wait. What are some of the costs?
Yeah, it's a great point, is that buying now versus waiting until later. I mean, there's a lot of interest rate risk there, as we've said. Even though we think things will settle down later this year, you don't know for sure. I mean, longer term, we're probably heading towards 6%. That's a given. And a good rule of thumb out there is that every 0.75% increase in rate will erode 10% of someone's purchasing power. Wow. Say that again. Every 0.75% in rate takes away 10% of your purchasing power. So if you look at this cost of waiting slide here, if you take a look at just as recently, over on the left side there, it says September of 2012. And we take there a median home price of $160,000. Rates back then were 3.25%. That would generate a monthly payment of $896 a month for someone. That includes $200 for escrows, for taxes and insurance. So the base payment somewhere right around $696. You look at that compared to buying now in the middle column. Home prices are up about 10% on national average. Might vary here depending on the community you're in. The home prices are up about 10% over the last year, and interest rates are up about 1.5 points. Well, those two things combined have eroded 30% of someone's purchasing power, because the 1.5 in rate took away 20% of the purchasing power, and now that same home costs 10% more than it did last year. So they've already lost 30%, and you see that it kind of bears out in the monthly payment as $11.18 a month now, higher. Or if you want to look at how much could they afford to buy if they wanted that payment to still be $896, takes it down to around $130,000. There's that 30% purchasing power that's gone. And then, finally, the last column there, if you wait 1 year and home prices go up just another 5%, because certainly, they can't keep cooking at 10% forever. We'll have another bubble on our hands. And I don't think they will as rates go up.
Right.
Certainly as rates go up, that's going to cool things off with the home appreciation. But let's say home prices just go up another 5% and rates pop to 6%. Well, now you see there the monthly payments all the way up to $1,309 a month. So it certainly doesn't behoove someone to wait it out and wait for interest rates to come back down or home prices to come back down. I think both of those things are moving north here gradually over time. So if they, to your point, if they find a home that they like, they're financially able to do it, now is still a great time to purchase a home.
Right. And from where we are sitting and where we can, this is a discussion that we have a lot at the Realtor Lender Committee about what are some of the things that we can talk about with you to help you with your clients. And You can call Annette, and she can always refer you to someone who can talk to them about it. It has been a real pleasure having a chance to talk to you about this. If you have any further questions, please, like I said, you can either type it on the system or you can text us, whichever works for you. Thank you so much, and we'll wait for your questions. Thanks, Ryan.
Thank you.
This has been pretty amazing. Okay, here I see a question here. We keep on talking about how people shouldn't wait. So if you've got a client that is saying, if you've got a client here who says that they want to wait, how should you talk to them about the interest rate? This is a question here from one of the realtors.
Well, to each their own. I mean, you certainly don't want to force anyone into anything, but at the same time, I think just laying the numbers out for them, like we did in that previous slide, we're happy to put together specific scenarios for people and make some assumptions or predictions based on where the market's going to go, and we can show them individually based on their price range, here's what you could get today, here's what it might look like 6 months or a year from now, etc. We're more than happy to do custom scenarios for folks and just let them know. And, for some people, maybe right now isn't the time to buy. Maybe they're in a situation where they're repairing their credit, that type of thing, and they can't afford to buy, or, they're in a new job, they need to save some money, etc. But for folks who are financially able to do it right now, it's tough to make an argument that it's not a great time to buy, with rates still being near historical lows and homes being, incredibly affordable.
Thanks, Ryan. Another question here is, do you see the rates, you keep on talking about the rates settling down, do you see them going back to about 4.5, 4.25?
Most people are thinking we get what's called a 50% retracement or correction, in the market, and in layman's terms, that would be probably somewhere around 4.25 on a 30-year, maybe 4% if we're lucky. Again, I think the 3% rates are gone in terms of the 30-year fixed, but they're there for 15-year fixed.
Oh, okay. So, Ryan, another thing, I think the old saying is that the graveyard is littered with the tombstones of economists that try to predict what would happen with the interest rates, right?
Right.
And I think on one of our realtor lender committees yesterday, they were talking about it. I'm not sure which company it is, but there's a mortgage company. So there's a question here. This one. On the realtor lender committee, they were talking about this one company that did not do the hedging, and they were out by a week. They managed to mismanage their hedging, and they went bankrupt.
Oh, wow.
They lost all their liquidity and their ability to.
They were looking for the number to text questions too.
Oh, okay. The number you can text it to is 513-600-4961. You can text your question to that. Or the other one is for Ryan, which is, what's it, Ryan?
Or you can text it to 513-314-2248. Again, 314-2248.
It has been our experience in the past that sometimes participants have trouble putting in questions. So if you have a question, just
Oh, okay.
okay, so
We did that.
we're waiting for that question.
Oh, mortgage defaults.
Oh, okay. The question is, there's still a huge gap between the current defaults on mortgages, very high, versus the foreclosures. Does it appear there is still a pig in the python? Do you foresee huge amounts of foreclosures left to hit the market, causing major issues? If this is the case, home prices could continue to be depressed and rates stay lower for longer.
Well, that's a great question. I mean, certainly we're not out of the woods yet on the foreclosure piece. Most of the numbers we're seeing says that they are getting better. I think there was a stat out just yesterday that year over year, the loans that are in default currently are down by 29%. Now, that's certainly still a huge number because it was an enormous number just a couple of years ago. So there certainly are still a number of foreclosures and REOs to work through. Now, that said, I think that the banks and Fannie and Freddie and HUD, FHA, they're doing a much better job these days of getting these properties onto the market and getting them sold quickly, whether it's the HUD REO program or Fannie Home Path program, and a lot of those loans will offer a renovation piece on them because, let's face it, a lot of those homes need work on them. So I'm cautiously optimistic on that in terms of the homes that are hitting the market. It doesn't seem like that looming shadow inventory that everyone was talking about a couple of years ago and was very worried about is certainly as big of an issue as we had worried that it was. I guess if that answers the question.
I hope it does, but there's another side to this equation, and I think this is where we sort of need to put a little perspective. The interest rate markets are not just governed by purely our fundamentals. They are controlled by people that move huge amounts of money in and out of their pension funds, central banks. I mean, it's just a whole bunch of people that are moving this money around. And what you see sometimes is like conversions in the market. And when things settle, there's a lot of profit taking or loss covering or whatever it is. And then when things settle down, they go back to realizing, yes, there are still a bunch of foreclosures, which is what you pointed out. The economy is still not doing that great. Europe is in trouble. Greece. I mean, the list goes on. So from where we are sitting, you can see that there is no real cause to panic. But at the same time, there also is no reason for a person to wait because of the other factors that can cause these markets to move. Ryan, I think another thing you may want to talk about is how renovation loans, particularly in dealing with some of these REOs and banks, how the banks have actually become much better to work with in getting some of these foreclosures done or foreclosed properties worked on. What are you seeing there?
Well, we certainly are seeing more renovation lending out there, whether it's just, there's a missing AC unit that someone took or, we did a couple last month that were, $30,000, $40,000 worth of upgrades for kitchens and that type of thing. So that is becoming more and more of the market. I know our prediction internally is that in 2014, approximately 25% of homes will qualify and or need some type of renovation lending on them. 25%, 1 in 4 homes will need some sort of renovation.
Wow.
Again, somewhat of a product of the amount of bank-owned, REO stuff that's out there.
And also people realizing that, the investors that were buying cash are probably getting out of the market. So the people that are buying it are going to be regular homeowners now knowing that these are the homes that they'll have to work with if they want to buy on the cheap.
Right.
Do you have any final thoughts?
No. Not really, other than it's still a great time to buy. We touched briefly on earlier that, I think the market is more worried about, the Fed exiting versus when it actually happens, because what will happen when they do start to taper is that, and we're seeing it already, that will strengthen the dollar. The dollar is up recently. That's why you're seeing oil and other dollar-denominated securities are more expensive now for other countries, so those prices will drop. So that's why gas prices are down a little bit here recently. Also, what happens with that is our exports are now more expensive to other countries, so the U.S. stock market will struggle a little bit because of a stronger dollar. What will happen then, ironically, that stock money will pour into the bond market and it'll keep interest rates down a little bit. So it's a little bit of a 180 from what you think might happen, but that's where we're heading. So I'm predicting fairly steady interest rates, through the end of the year. Probably a lot of volatility in the market, a lot of ups and downs, but overall a range of say 4 to 5% on mortgages. I don't see us hitting 5.5 or 6% anytime soon, meaning this year.
And to finally, firstly, thank you very much for attending and for your questions. But the last thing I want to say is that it is clear that in terms of policy and the politics, everyone has decided that this country's economic recovery is going to be on the back of the housing industry. And based on that, we are the tip of the spear. We are the ones who are going to help people bring this country back economically. So we are in a very, very, very good business. I think it's very optimistic of what can happen with us. And we really look forward to fantastic years. And it could be a secular trend for several years.
Yeah.
It could be a trend starting now that could last another 5-10 years.
Yeah.
So there's much to be optimistic about. Thank you so much. And if you have any questions, you can call either one of us directly. Thank you and have a good day.